Thomas Crasting. I'm a deals partner with PwC. I principally focus on mergers and acquisitions and fundraising. I've spent 15 years in the space. The last 4 to 5 years have been dedicated to the Web3 sector, helping startups and scale-ups like yourselves raise capital from institutional asset managers, venture capital funds, growth funds, and sovereign funds. Before we dive into the presentation today, I thought it might be useful just to provide a little bit of background on the PwC Web3 team and more specifically the PwC Venture Growth Hub. I'm aware that there's some familiar faces in the room today, but also some new ones. So looking forward to getting to meet you in the clinic sessions later. But I often find that many people are not necessarily familiar with what PwC is doing in the space. So let me just spend a couple of minutes giving you a bit of background. So PwC's entry into the crypto space started in 2017. To date, we've got 70 plus professionals based here in Hong Kong, supporting Web3 players like yourselves. We've over the last 6 years, we've worked with a combination of digital asset Web3 native businesses across the CeFi and DeFi space, helping them on their journey and their growth aspects, but also supported TradFi players and asset managers, sovereign funds, venture capital funds and growth funds investing into the sector. I think what we realized earlier this year, but back in 2023, was that whilst we're very much servicing kind of the big end of town, there's a really big unmet need within the startup and scale-up community. Many of your players there, you need the support and advice from professional advisors like us, but us as an organization, we're not set up to service you. We have all this experience and knowledge that we want to share, but it wasn't packaged in a way that can be digested and used by you. And so with that, we set up the PwC Venture Growth Hub, really with the primary objective of supporting startups and scale-ups like yourselves on your institutional journey, helping you navigate through the complexities so that you can achieve your vision and success. And with that, we've got a dedicated team of professionals. Many of those are in the room today, and you'll get an opportunity to meet those individuals through the clinic sessions. And they bring a combination of Web3 expertise, but also functional expertise across legal, tax, accounting, fundraising, risk, governance, and operations. And what we've really focused on is ensuring that we've got a proposition that caters to the needs of startups and scale-ups. And so that's not only focused on the needs and wants of what startups and scale-ups need, but also priced accordingly. And we understand that money is tight and there's often a limited runway, and hence we've structured it accordingly. We'll talk a little bit more as we go through the presentation about how we support startups, and obviously we can dive into a lot more detail during the one-on-one clinic sessions as to what we do and how we support. So today, before we jump into this first slide, today I guess what I wanted to share with you was how we support startups on that institutional journey. And there's a lot of different aspects of how we support startups. But as I was sort of thinking about what would be most valuable for yourselves this afternoon as we present to you is reflecting on kind of some of the conversations that we've had with startups over the last 12 months. And I think that the most common question we get asked is, how do we get access to capital? I think fundraising is often like the most important topic that startups are dealing with. And I would say most founders are always fundraising, whether they've just closed a round or they're looking to do a new round. But it's always kind of the hot topic. And so I thought we'd start off the presentation with our thoughts on how you access capital. And I think, as we can see here, and this isn't kind of a new slide to probably many people, but throughout the entire life cycle of a startup, you're going to need to access capital. And those different capital pools are going to vary across the life cycle of your business. And so I think there's a couple of messages I wanted to leave with you today. I think the first one is really about knowing your audience. So when you're going through a fundraising process at the various stages, whether that's seed, Series A, B, C, it's important to understand kind of the needs and wants of the investor. So their risk appetite, the funding checks that they're going to provide, their investment term, their return that they require from the investment, their timeline to hold investments is going to change. And so I think it's really important for you as founders to really think about who is it that you're talking to. It might sound like an obvious question, but I think doing your diligence and doing your homework on the investors that you're approaching is really important, because there's obviously a very clear demarcation between someone who's going to be a seed investor as opposed to someone who's going to be a late stage investor. I think the other thing that's important to understand is that, and really this is kind of an interesting data point that we've seen, is that during the course of 2023, I mean, everyone's seen the numbers. It was a horrible year for VC. Kind of VC funding fell off a cliff. And I think really the characteristics, needs and wants of venture capital and growth investors has changed. I think we've really seen a clear shift in terms of how investors are analysing and looking at different investment opportunities. And I think one of the things that we've really seen is the level of scrutiny that investors are putting on new investment opportunities has really increased. So, it's probably no surprise that late-stage venture capital funds, growth investors, private equity funds, they're going to do a lot of diligence when they look at investment opportunity. When someone's deploying 50 to 100 or 150 million US dollars, that's a serious check. But what we've seen is that same level of scrutiny start to filter down into the venture capital area. And I think really that the key message I wanted to give to you as founders is, gone are the days when you can go and raise capital with a one-page PowerPoint presentation. Or in certain situations where someone just rocks up to a VC, they do their pitch and they say, here's $1 million US, go for it. I think it's really important for founders to recognize that sort of the landscape has changed, and being really prepared for those investor conversations, whether that's at the seed stage or at the Series C and D. I think that's really important, because that overall landscape and scrutiny that investors, as well as their investment committees, is changing. And we're seeing that across the entire investor universe. The second last point to raise here that we're seeing is, when you're going through that fundraising process, thinking very carefully around the amount of money that you're looking to raise and at what valuation is important. I think I often talk to founders and they haven't necessarily got a clear vision as to how much capital they want. And I think it's important to understand, particularly as we've come through the recent cycle and we've seen a lot of flat rounds and down rounds, that raising the right amount of capital at the right valuation is important. I think the biggest mistake that we see from startups and scale-ups is raising too much capital at too high a valuation. And I think that's really important as we, touch wood, for hopefully coming into the next bull cycle, where valuations will start to rise, capital will start to be more heavily deployed. Not to get ahead of yourselves and raise too much capital at too high a valuation, because essentially you're potentially setting yourself up for failure if we then do move into another downward cycle. I think the last message, and this is hopefully a bit of a bit of sunshine for you, is you as founders should be picky when it comes to investors. I'm increasingly seeing and hearing from when I talk to the investor community that they're recognizing, and this is even within the Hong Kong landscape, that they're recognizing that there's increased competition amongst the asset managers. And they're sitting back going, how do we differentiate ourselves amongst the startups? And so I think I impress upon you as founders to really challenge the venture capital funds, challenge the growth investors when they're coming to you to say, I want to be on your cap table. Challenge them as to what value you are bringing to me. Yes, they're bringing capital, but what else are they bringing to you? And I think as you look to build out your cap table, and you look to, obviously you're going to have more than one investor on your cap table, but as you look to build out your cap table, think about what value are each of those individual venture capital funds bringing, because they're all going to have a unique proposition. And I think the other thing I would say is holding them accountable to that. Because too often we see venture capital funds promise the world, but really deliver nothing other than the capital. So whilst many of the times you think you have limited leverage, I think I would say that actually you've got more leverage than you think. And the venture capital funds are seeing the pressure because of the competition. And that's even within the Hong Kong market. Final thing I thought I'd do is just sort of share some thoughts on some of the venture capital funds that we see as being quite active, particularly within the Hong Kong landscape. we all know of some of the larger funds, A16Z and others that are very active on a global scale. But I'd say that there's a very thriving and vibrant venture capital market in Hong Kong that you should be tapping in. Obviously, we can help through facilitating those conversations. So at the sort of the seed in the early stage, you've got people like Newman Capital, Token Bay, Superscript, Foresight Ventures, Hivemind Capital, just to name a few. Some family offices, Maelstrom Capital, Arthur Hayes' fund. When we move into more of the growth stage investments, people like Dragonfly, Animoca Capital, who's based in Cyberport, 10T, Sequoia China, all very active within the Asia-Pacific Hong Kong landscape. So again, the message I want to give to you is we hear a lot about venture capital funds. There's obviously a massive, deep market in the US, but there is increasingly a very vibrant and deep liquidity within the Hong Kong market across the entire fundraising spectrum. Having spoken to 100 plus investors over the last 4 years investing in the Web3 space, I think it's fair to say we've got a fairly good perspective as to what investors are looking for. And when we reflect upon all of those conversations, it really boils down to 5 key areas: management team, product innovation, market fit, risk and governance, investment case. And I think really the first and foremost and most important thing is the management team. At the end of the day, VC funds are investing in people. Yeah, and I think it's important to understand that. Too often we have businesses, startups and scale-ups come to us. They've got a great product, but they can't raise money. And they can't raise money, why? Because they can't pitch. They can't present their product. And so if you're going through a process now or you're thinking about fundraising in the future, I think it's really important to not underestimate the importance of how do you present to these stakeholders. Your pitch is important, but also how you personally present to them, because at the end of the day, they're backing you. Product innovation is obviously important. You need to have a unique proposition. It needs to be solving a real-world problem. And I can't emphasize enough about that real-world problem. That's what VCs are really looking for. What are you actually solving for? And if you can't articulate that, then frankly, I think you may as well pack up shop or ideate and re-innovate. But I think, again, coming back to the importance of people, VC funds recognize that probably the product that you're presenting to them today, particularly if you're a seed stage business, is likely going to fail. Yeah, you're going to need to ideate, you're going to need to reinvent the wheel. And again, that comes back to the agility and the resilience of the individual and the management team to be able to do that. So again, it comes back to it's the person. The product is important, but it's the management team that's doing that. Market fit, that's an obvious one. But I think the key thing here, and again, this comes back to kind of the current market conditions, is about product market fit and the business model. We've seen a real shift in investor sentiment over the last 12 months, where there's been a shift from focusing on growth and product innovation to focusing on profitability and runway. I just ran a panel at the FinTech Week a few months ago, and it was really about cash is king. Yeah. So again, you're starting to see some of the growth and private equity characteristics of what they look for in investment seep into that venture space. So I think that's really important as you build out your businesses, thinking about what is your business model. Too often people focus on the product innovation, but forget about the importance of how are you actually going to make money? What is your revenue model? And what is your pathway to profitability? And I think that's even important for businesses that are going through kind of their proof of concept. Because if you haven't got a view on that, then frankly, I think VC funds are going to start to look elsewhere. Risk and governance, I think that's a no-brainer. I think particularly in light of all of the recent events over the last 2-3 years, increasingly, I think this is now on the top of every investor's diligence questionnaire. How are you thinking about governance and risk? Now, as a early stage businesses, do you need a fully fledged governance framework, risk management framework? Probably the answer, unless you're in the regulated space, the answer is no. But if you as founders are not thinking about how do you monitor and manage risk, that's going to be a red flag for investors. So again, it's thinking about how do you present and position to yourself, to the investor community, that you are stewards of your own business and you're thinking about risk and governance, or at least you've got a plan, or you've got some kind of solution there to be able to help you in those times of need. I think the biggest area where we see kind of risk is around financial hygiene. So, commingling of digital assets, commingling of cash with personal records. So again, these are increasingly areas of focus, as well as just thinking about legal and regulatory risk. I mean, this industry is increasingly moving down the regulated path. So if you're not thinking about, again, maybe this is a bit of a cue to say, what are you doing as a business? And I think finally, it's about that investment case. As I said, the focus is really around profitability and runway for investors. Return is important, but they want to make sure that business that they're funding has good runway, both pre and post investment. They want to make sure that business can get through the next cycle. Hopefully that's useful. Hopefully kind of there's some things there that might help you as you go through your next fundraising discussions. Pivoting away from fundraising, I thought it might be useful to, coming back to the title of today's presentation, institutionalization, and what do we mean by that? Really, from our perspective, institutionalization is something that is important throughout the entire life cycle of a startup's business. And from our experience talking with startups and scale-ups within the Web3 space, we kind of put it into two buckets: growth considerations and operational considerations. I think it's fair to say that most founders and founding teams are really good on the growth considerations, give or take a few areas. Talent, setting themselves up with the right teams and expertise, product, innovation, thinking about how do they ideate, how do they kind of solve that next problem, business model traction, gaining revenue, customer acquisitions to show to investors that this is a viable business model. I think the only area where maybe there's a bit of gap is around the network and fundraising. I think too often we see founders go and raise capital and then kind of set and forget. Remember that you as a founder, you have many different hats, and investor relations is one of them. So keeping your investor base, both investors on your cap table as well as prospective new investors, informed as to how your business is performing is really, really important. But I'd say that most startups we talk with, the growth considerations is something where I'd say they're doing reasonably well. It's really the operational considerations where I think we see kind of the biggest challenges and areas where there's probably some oversight and room for improvement. And if I kind of just touch on a couple of these, and I'll sort of go from top to bottom, I think risk management, controls and governance, probably the area where we see the biggest gaps is around digital asset safeguarding. Too often we come across businesses where digital assets are held in someone's personal wallet, they're held on exchange. I think all of the recent events have highlighted the inherent risks of doing that. And again, that just becomes a massive red flag for any investor. Regulatory and compliance, as I said before, this is an increasingly regulated industry. Even kind of the events on Wednesday are indicating that we're moving further down that path. And I think a lot of the businesses that we talk to are not necessarily investing enough time to monitor that regulatory landscape and how new regulations are going to impact their business. And I think that becomes increasingly challenging for the Web3 community because we have such a decentralized and global business. So we're not just based in Hong Kong and operating in the Hong Kong market, but we might be we might have teams spread across the world. So what does that mean from a regulatory and compliance basis? But we're also selling across the world. And so are there new laws and regulations coming in different regions and geographies that have implications on us? This is hard to manage, but this is the nature of the beast in the industry that we operate in. Cybersecurity, again, very much around digital assets and the inherent risk there, and making sure you've got those assets safeguarded. Auditing and accounting, again, something which is often overlooked at a seed stage, but I think as businesses get into the B and the C and they start to kind of raise capital, more serious institutional capital, I think this is where we see kind of the biggest hiccups. And I think the biggest red flag is when businesses have done a token issuance. And just how do they account for that? How do they deal with that? How do they present that to investors? Again, if there's any of you in the audience that have or are looking to do token issuances, kind of just think, go and seek some outside counsel, because this is kind of a big red flag. Tax, lots of different tax issues, but for me, I think the biggest one is around ineffective tax structuring and doing that too late in the piece. And I'll come to that in a second as to kind of when is the right time to think about that. And lastly, I think HR, probably lower on the risk spectrum, but again, because Web3 operates on a global basis, we have such a decentralized workforce. Again, it kind of comes back to that regulation compliance, navigating the laws and regulations, and also the knock-on implications of having people that might be sitting in Europe or the US, and what does that mean from a regulation or even a tax perspective as the business becomes profitable? Are you exposing yourself to tax risks? So again, hopefully that gives you a bit of an overview, but the next question we often get asked by founders, they say, okay, that's all well and good, but I've got so many different things to do. I've got to build a product. I've got to go and get customers. I've got to generate revenue. Like, I don't have the time, capacity, or money to do this. Like, when do I need to do this? Do I need all of this now, or is it a staggered approach? And I thought what would be helpful is kind of to give you a bit of a timeline. So in our experience, there's very often clear trigger events that will be an indicator of when you might need to start to think about some of these institutional initiatives. And I'm not going to go through all of them, but I'll just touch on a couple of them. So typically at the seed stage product launch, many businesses often overlook the importance of getting some tax advice to get the tax structure right. Now, you might go, why I'm not revenue generating, what's the point? Think about it. The valuation of your business is probably pretty low. Yeah? Getting the right tax structure at day one is far more cost effective and is going to save you pain doing that now as opposed to when you're at a Series C and you're valued at $1 billion US. Because if you need to restructure the business, there could be some hefty tax bills. So that's just one example. Go to market, fundraising, we've spoken a lot about that. ESOP plans, etc. Again, it comes back to kind of setting the right valuation, getting the right tax advice. I think that's probably a common area where people do go out and get the right legal and tax advice for ESOP. But again, if you are looking to do an ESOP, it should be a trigger event to go, okay, have I sought the right legal and tax advice? Because if you don't, you're potentially exposing yourself and your employees. I think when you're getting to that Series B stage, I mentioned before about the financial hygiene, the accounting records, etc. That's probably at a time when investors are really scrutinizing the financials of the business. By that time, you're likely revenue generating, you're potentially profitable. And so really having good quality financials that kind of represent the business is really important. And so on and so forth. So I guess my point being is, if I go back to this slide, you don't need all of this on day one. I think as founders, you need to be thinking about this because increasingly investors are wanting to make sure that founders are aware of all of these aspects because this is important. But hopefully this gives you an idea of at certain events through your growth cycle when you should and shouldn't be thinking about things. I mean, just to wrap things up, so hopefully that's been useful, insightful. I guess what we wanted to do is share some of our thoughts and experiences from the conversations we have both with investors, but as well as with other startups. And as I said at the start of the presentation, the PwC Venture Growth Hub is really here to support startups and scale-ups. We're very much focused on investing in the Hong Kong ecosystem. The success of the Hong Kong Web3 ecosystem is important for us because obviously that provides business opportunities for us. So essentially what we have is we have a combination of tailored solutions that are kind of mirrored to those institutional operational considerations, as well as a managed service solution. So we'll talk about this later through the one-on-one clinics, but we have a Web3 Essentials package, which is really there to provide you with effectively a management team in a box, a CFO, a tax, a legal advisor, a fundraising advisor, all in a box. typically priced at $10,000 a year. I think we're happy to offer some one-off discounts to people who are here today at $8,000 a year. Little plug for the Cyberport guys. But really my key point is we've got a combination of the tailored solutions as well as some package solutions for you, again, at a level that's digestible, and we support you across that entire life cycle. Finally, this isn't all of the people. As I mentioned before, we've got 70 people in Hong Kong focused on Web3. These are some of the core team members that sit across our Venture Growth Hub. So Joyce, Cornell, Matt, Lewis, Matthew are all in the room today. You're going to get an opportunity to have a one-on-one session with them. Each of those bring a combination of Web3 experience, but also a functional experience, which we've tried to highlight there. That was it. Thank you for your time. Looking forward to getting into more detail about your businesses and see how we can support you. Thank you.